What's up, guys, and welcome to the channel. I wanted to start off my channel with a 0 to 100,000 stock and crypto challenge. So, and I know what you're thinking, it's not zero right now. It's at 14,787, but I wanted to get to 100,000 and I wanted to take you guys on that journey. So the first fund that I have, I kind of rank them by importance. And I just wanted to first start off and say that my portfolio is very growth oriented. So I'm all about growth, which of course with growth stocks and growth ETFs, there comes that, risk and reward. But since I'm young, I'm willing to add a little bit more risk to my portfolio. So starting off, we have SCHG, which is a large cap growth ETF. So it tracks all of the growth stocks and kind of puts them all together and allows you to trade that fund. That's what an exchange traded fund is. And I also wanted to mention too that I'm not a financial advisor. Don't take anything that I say as financial advice. I'm just here this is really just for fun and to kind of take you guys on this journey. So anyway, we have, what I really like about this is that, that 5-year return looks really good. I think it was at 187.20. And something that I like what Robinhood does right here is you can look at the average annual return. They only do this for ETFs right now. I don't know if they'll start doing it with stocks or not, but this is kind of a new feature where they'll show you, the average breakdown. So the net average return over the past 5 years is 22.78%, which is really good. And that's why I enjoy this ETF. And the next one we have here is Costco, which of course we all know what Costco is. It's very similar to Walmart's Sam's Club, where you can buy retail items, food, groceries, even clothes in bulk. So Costco is a stock I've been following for a long time now, but I just recently bought this year. But I was kind of waiting for the dip this year and it never really dipped. And so I kind of bought on its way up, and going into the holiday season here, I don't think it really has signs of stopping, and that's just my opinion, of course. So I've made 8.61% over time. The next one is Abbott Laboratories, another solid company that's had great returns over the past 5 and 10 years. So like I mentioned before, the goal that I look at is a high market cap and a low PE ratio. You want to look for PE ratios between 10 and 50. That means that the company is beating earnings and doing well. So the past year it's been doing well, and the past 5 years it's been doing great. So with a return of 211.12. And I also like growth stocks that have solid returns but also pay a dividend. So just in case if the stock, dips down or crashes or has a little bit of a correction, I'm still getting those dividends every quarter or every month if it's a monthly dividend paying stock. So right here, as you can see, I bought it. I put it in about $90 and received about a 10% return. The next one is Adobe. And again, I make a lot of mistakes investing, and this was one of them. So I bought Adobe at about $400 a couple months ago, dipped down to $410, and I actually panic sold. I don't know what I was thinking. I sold and I bought back. So Integris Health is another awesome stock. This return of 5 years is in the 757, and just another great stock that is a growth stock and pays a dividend. Exact Sciences, it's not doing too hot this year. It's down 12%, and I am down 20.8, almost 21%, with a loss of $123. Thankfully, I don't have too many shares with Exact Sciences. Atlassian or Team, one of the best performing stocks in my portfolio. It is up about 100% this year and 1,400% over 5 years, which leaves me with about an 80% return because I bought a couple months ago, and I did have to sell one share. I think I put that into another stock, so I did sell one share of Team. ProShares Ultra QQQ or QLD. This is a leveraged ETF, meaning the stocks or the funds that it tracks, if those go up 1%, this one goes up 2%, and vice versa when it goes down. So pretty risky. Again, I only have a couple shares of this and don't really recommend putting too much money into funds like this because you will lose a lot when the market has a downturn. I'm up about 9% on this one, which is, again, pretty good, but I've only owned it for a couple months and the market's been doing well. So if you look down here at the 5-year return, it's almost 50%, but that's because we've been in a bull market for the past 5 years. So if there ever is a correction in the market, you will lose quite a bit. Next is Target, another very solid retail company. They plan on hiring over 10,000 new employees for the holidays and will continue to do well. I expect the stock price to go up a little bit more towards the end of the year. Heading into railroad companies, Canadian Pacific Railway. This was recommended to me actually by a friend a couple months ago. Bought it around $66, $68. Only have one share of this, but I'm up 14% and pays a dividend. High market cap, low PE ratio is what we want. So just a solid company that I plan on buying. Another railroad company, Union Pacific. Again, bought this one at, around $198, just under $200. And this one's up, I think, 19%. Mastercard. I'm not sure. I kind of have mixed feelings about Mastercard. This one, everyone talks about, everyone kind of hypes up quite a bit. It's definitely a hold stock. I'm actually down a little bit. It looks like it's flat, and I plan on buying Mastercard again for the next few years. Sun Communities, a great real estate stock if you want to diversify your portfolio. Solid growth here on this stock and also pays a great dividend. So another one to hold for a couple of years. This next one I probably should put right next to my other growth ETF, right under it. This is a Vanguard Growth ETF. I like it, but expense ratio is a little bit too high. Intuit owns QuickBooks and TurboTax, pretty solid company. Bought this one a couple months ago as well. And it's done very well in the past 5 years. It has that beautiful 5-year return of 450%. Past results don't equal future returns, but from the research I've done, I'm expecting it to continue to climb. Next one is IDEX or IEX. This one, to be honest, I didn't even do any research on. I just kind of found it and threw $50 in. But it's got that return of, it's got the dividend that pays 13 cents off of just a $50 investment, and I've got almost 7% return. High market cap, low PE ratio. It's what we look for in when we're buying a stock. The next one is Zoetis. Pretty awesome company, actually. I'm a dog person, and this is a veterinarian pets supplies company. It kind of has a monopoly in that regard, and it's done very well, and I've just kind of been watching it like I have with my other stocks. So only a $50 investment there, but I love this stock. I like the stock, is what some people will say, and I think it's done very well. It's got great analytics, and I will continue to watch this one and buy it. NVR is a real estate company, definitely a hold stock as well as some other ones I have in my portfolio. Hovers around that $5,000 range. Right now it's at $48.75. I bought it, I think, at $49, put in $100 there, but we'll continue to hold this one. It's been a hold stock for the past 30 years and has just substantial returns over the past 30 years. Five9, a cloud computing company or telecommunications company similar to Zoom. I don't like this. I don't want to talk about this one. I've lost a lot of money, and long story with that one as well. So I work for Volkswagen, and Volkswagen is a huge company, owns Audi owns Lamborghini, the list goes on. So Volkswagen's kind of the mother company to all of those, and just one of my favorite companies. So this next one, I really need you guys to hear me out. Okay, so RingCentral, similar to Five9 and Zoom, was doing really, really well at the beginning of the pandemic. The revenues were doubling and tripling, and they were having incredible returns. And so I thought that the pandemic was going to continue on, the lockdowns were going to continue. So I started buying RingCentral like crazy, and it was around $250 last year in the stock price. So I started buying some shares, and then it started to take off even more. It skyrocketed above $300. went up into the 400s, and reached a peak of $449 around February of this year. And so that obviously got me excited as well. So as you can see here, up to 437, started to come crashing down at its peak. And so naturally I started dollar cost averaging, and I now have a average price of $304.50. So I'm down $3,400, almost $3,500 at an 18% loss. Again, don't judge me about my loss here. I'm currently bag holding until it reaches above that average cost. And that way, or once that happens, I can then sell and start diversifying my portfolio even more. That's why I only have like one share or fractions of shares in the rest of my stocks, because again, I made a mistake, but that's how we learn, and I will hold this until I turn a profit there. So learn from my mistake. Don't keep buying if a stock is crashing down. Dollar cost average, but do it a lot slower than I did. I did it within a matter of months. If the stock is continually going down, I would say buy in like once a month. So Fair Isaac is another one that hasn't performed very well these past couple months. All my other stocks, excluding Ring Central and a few others, have done phenomenal. This is another one that hasn't done very well at all. I'm down 8% there at an average cost of $449, but I only put in $100 into this one. So the next one here is SL Green Realty. So I really like dividends, as you guys know. And in another video, I plan on going over just the dividend paying stocks that I own and kind of explaining my strategy with dividends. So SL Green Realty is a real estate investment trust, or a REIT, pays 5% a year with monthly payouts. Horizon Technology Finance, again, another dividend paying stock that pays out monthly. Got a 70-cent dividend payment recently, and pays about 7% a year in dividends, which obviously is month to month, which I love. The next one here is Dynext Capital, and I've received $1 each month. It's got an 8.74% yield, which again, I love the high paying monthly dividend stocks. So this is one to look into as well. Next one here is Stag Industrial. I would actually buy a lot more shares of Stag if it wasn't so high right now. It's at its all-time high, pays 3.32% per year, but continues to grow. So it's really just kind of like a slowly growing stock that pays a dividend each month. So I love it. Prospect Capital, I think this is a good one to buy a couple shares of if you're starting, if you want to only put $100 into the stock market, but want those dividends. I think this is a great stock to start with. Pays a great yearly return, 8.60%. The next one is ProShares S&P 500. Pays the dividends of a bunch of high-paying dividend companies or stocks. It's that ETF that has hundreds of those. And this one done pretty well the past 5 years, 14%. Pays that 4.15% dividend each year. Of course, paid out monthly. Next one is Agnc Investment. This is my favorite one, actually. So I receive about $5 to $6 a month from Agnc, and planning on buying and holding this one for the next probably 20 years, honestly. But the goal here is to bump that up to, $150+ a month just in dividend income. And, that's the same thing as owning real estate, just without any work at all. You're getting paid just by owning these shares, which I really like. Next one here is Gladstone Investment, or GAIN, $15.22 per share, and pays about 53 cents a month for me right now. But I'll plan on buying more shares as well to bump those numbers up. Pays 5.5% per year, pays out monthly. JEPI, or JP Morgan Equity Premium Income, is a newer high dividend paying stock. As you can see, it just was listed May 21st, 2020. So about 18 months ago, it was listed on the New York Stock Exchange to be traded publicly. But this is kind of another experimental stock, pays a great dividend each month. It's about $62.14. And yeah, so $7% dividend payments each year, paid out monthly, which I love. So I'll continue to watch this one. It might be volatile at first. It's kind of hard to trust when they haven't been on the NYSE for very long, but it's another great one to look into and do your own research on as well. Realty Income, or O, is another REIT or real estate investment trust that pays out monthly. And I like this one too because it continues to grow every year, but still pays that high dividend of 3.96%, very similar to Stag Industrial. So that is it for my REITs and stocks, but of course we can't forget cryptocurrencies. Ethereum is the only one I currently own. I know I probably should own a lot more, but I've just had a lot of faith in Ethereum lately, and I only have about $100 in here. I've been buying and selling this for the past 4 years, and continue to hold this one now instead of buying and selling it. So that is it for my portfolio, guys. If you like this content and you want to continue on this journey with me, make sure to like and subscribe. All right, thanks, guys. Peace out.